You know what blows my mind? The entire investment world is built on this idea that risk equals reward. But what if that fundamental belief is completely wrong?
That's a pretty bold challenge to conventional wisdom. What makes you question such an established principle?
Well, here's the thing. If risky investments reliably produced better returns, they wouldn't actually be risky at all. It's like saying jumping off a cliff will always make you rich. The reality is far more complex and fascinating.
When you put it that way, it does seem like we might be missing something important about how risk really works.
Exactly, and let me give you a perfect example that just happened. Look at Nvidia, their stock dropped more than 50% in 2022, which looks incredibly risky on paper. But then it tripled by 2024 because of AI adoption. The price was volatile, but the underlying business fundamentals remained solid.
So you're saying there's a difference between price swings and actual risk?
Exactly. And here's where it gets really interesting. Take US Treasury bonds, which are supposed to be the safest investment on earth. They lost over 30% in 2022 when inflation spiked. Nobody saw that coming, and that's the kind of risk that really matters. The unexpected ones that don't show up in our fancy mathematical models.
That reminds me of what happened with Silicon Valley Bank. They were loaded with those supposedly safe government bonds, right?
Oh man, SVB is the perfect case study. Their portfolio looked bulletproof by traditional risk metrics, but they completely missed the real dangers, their unhedged duration exposure and concentrated deposit base. When rates spiked, it was game over.
Well, that makes me wonder, how do different types of investors handle these risks differently?
That's such a crucial point. Think about a hedge fund versus a pension plan. They might own identical investments, but their risks are totally different. The hedge fund is worried about immediate margin calls, while the pension plan is thinking about meeting obligations decades from now.
And I imagine there's also the whole career risk angle that affects how professionals manage money.
You know what's fascinating about that? In the professional investment world, it's often considered safer to fail conventionally than to succeed unconventionally. The pressure to conform is so strong that managers will knowingly make suboptimal decisions just to avoid standing out.
That seems like it could create some pretty significant market inefficiencies.
Absolutely right, and that's where the real opportunities come from. Take Warren Buffett's approach at Berkshire Hathaway. Everyone preaches diversification, but Buffett's portfolio is highly concentrated in what he truly understands. It's about having the courage to be different when you have genuine insight.
Speaking of understanding things deeply, how has technology changed our ability to assess risk?
Well, here's the irony. We have more data and computing power than ever, but the most dangerous risks are still the ones that hide in the tails, those improbable disasters that feel impossible until they happen. Think about the pandemic or the 2022 bond market meltdown.
So what's the solution? How do we navigate this complexity?
The key is understanding that risk isn't something to be conquered, it's something to be respected and understood. Look at successful distressed debt investors. They deliberately buy securities that others fear, but only when prices already reflect deep pessimism. They're not eliminating risk, they're ensuring they're well compensated for taking it.
That makes me think about how interconnected everything is now. A problem in Taiwan can crash markets in New York and trigger pension issues in London.
Exactly right, and that's why traditional risk models keep failing us. They treat markets like simple mechanical systems when they're really complex adaptive networks. The dominoes fall in ways that no model can predict.
So how do we prepare for that kind of uncertainty?
The answer lies in building resilience rather than trying to predict every possible outcome. It's about maintaining what I call root intelligent exposures, understanding the risks you're taking, ensuring you're being well compensated for them, and most importantly, structuring your portfolio so you can survive the unexpected.
That sounds like a much more nuanced approach than just trying to maximize returns.
You know what's fascinating? As AI and machine learning become more prevalent in investing, there's this temptation to delegate risk management to algorithms. But real risk intelligence requires human judgment and the ability to sense when historical data has lost relevance and when to admit we don't know something.
So what's the key takeaway for people trying to navigate all this?
I think it's about embracing risk as an essential part of investing, not as an enemy to be defeated. The goal isn't to avoid all risk, it's to understand it well enough that you can use it to your advantage. The best investors don't just survive market storms, they position themselves to thrive because of them.
That's really changed how I think about risk in investing.
And that's exactly why this conversation matters. When we start thinking about risk as a story rather than just a number, we make better decisions. It's not about being fearless. It's about being thoughtful and prepared for whatever the market throws at us next.